You buy a single business to escape hourly wages. You acquire competitors and build new divisions to multiply that income. You establish a holding company to manage the portfolio. A 60-year-old man pushes a manila folder across the conference table. He voices his asking price. You sit across from him with $90,000 in your bank account and an unknown reputation. Your ultimate goal involves acquiring 20 separate companies and controlling $500 million of accumulated effort from other entrepreneurs. The seller dedicated 31 years to building his current operation, working weekends and missing family vacations to grow the customer base. He faces a market condition where buyers have left the pool. 4 out of 5 business owners who list their companies fail to finalize a transaction. The man pushes the folder in your direction because you took the time to attend the meeting. You view this physical folder as your initial step into entrepreneurship. Most aspiring buyers fail to advance past the next phase. The seller sits across from you studying your facial expressions to see if his asking price makes you flinch. We call the initial phase the searcher stage. You are 31 years old. You possess $90,000 in personal savings sitting in a high-yield account and a digital spreadsheet containing 900 potential targets that you sourced from broker websites and public county records. Your current role involves zero purchasing. Your sole duty requires constant searching. You perform this specific occupation for zero financial compensation. Financial professionals label this exact strategy a self-funded search. You must apply strict realism to the underlying mathematics. You want to acquire an operation generating $1 million a year in seller discretionary earnings. You use this metric to track the exact cash amount the current owner deposits into their personal checking account. Companies generating this specific income level sell for 3 to 3.5 times that annual figure. You look at a target acquisition carrying a listing price near $3.5 million. Your available capital sits at $90,000. You focus on bridging this $3 million shortfall as your primary objective. You study corporate profit and loss statements with the same focus a mechanic applies to a running engine. You discover the current owner expensing his personal pickup truck, his spouse payroll, and a recreational boat through the company accounts for the past 10 years. Separating the true financial performance from the personal narrative the owner believes requires hours of spreadsheet work. You increase your final purchase price by $3 or $4 for every single dollar of personal expenses you validate. You push the seller to keep legitimate expenses on the books. You discard any personal expenses that a commercial loan officer will reject during underwriting. You drive 4 hours on a Tuesday to meet an industrial filter manufacturer. He refuses to sell his company. He wants a younger person to convince him to keep working on the factory floor instead of retiring to a quiet house. You separate public auction listings from private off-market opportunities. Brokers market their public listings to dozens of wealthy investors who drive up the asking price. You gain your true advantage by finding private deals. You target owners who postpone selling their companies. You contact these individuals months before a formal auction begins. You send physical letters via certified mail to business owners who refuse to advertise their availability on public exchanges. Your initial potential acquisition fails during due diligence. You review financial documents that look perfect until you ask the owner to name his top 3 clients. The owner admits one single client generates 60% of his total revenue. That specific client has a contract renewal in 8 months and lacks any alternative suppliers. Commercial bank loan officers refuse to finance an operation relying on one single client. You pack up your documents and leave the meeting. You spend 2 months of effort and pay a substantial legal invoice on this failed deal. You learn more from failed transactions than from successful ones. Aspiring buyers abandon their search when this exact frustration builds. They give up after reviewing their 10th failed transaction and realizing sellers refuse to hand out free opportunities. You mail 41 physical letters during a single month. You receive 2 responses. One of those 2 responses is the manila folder sitting on the conference table. You lack the experience to understand the true cost of that folder. You must drain every liquid asset in your bank account to secure this specific acquisition. You must also sign a personal guarantee binding your legal name to a financial obligation that you cannot reverse. Level 2, the buyer. The documents inside the folder reveal a final purchase price of $3,800,000. You are 32 years old and possess $90,000 in cash. Purchasing a $4 million asset with those funds requires a financial mechanism. A bank purchases the company while you provide a signature. The government backs this transaction through an SBA 7A loan program authorizing up to $5 million for business acquisitions. Financial institutions build these deals using a capital stack. The lending institution covers 80% of the total acquisition cost. The retiring owner finances 10 to 15% of the purchase price. This arrangement forces the seller to loan you a portion of his own asking price and trust a stranger to repay the debt. You cover the final 10% out of pocket. 10% of the purchase price equals $380,000. Your $90,000 savings covers a fraction of that requirement. You convince two former coworkers to contribute the missing funds in exchange for equity shares in the new enterprise. A single electronic wire transfer drains your personal bank account down to the last few dollars. Federal lending regulations offer a loophole to ease this cash burden. The seller's finance portion qualifies as your personal equity injection, provided the debt remains on standby. This condition prohibits the seller from collecting any principal or interest payments during the first 24 months of the loan term. You request this 2-year payment pause from the entrepreneur who spent 30 years building the operation. He accepts the delay because closing the transaction remains his top priority. This standby agreement determines whether the bank approves or rejects the entire transaction. The lending institution mandates a quality of earnings review before releasing any funds. Independent accountants dissect the financial statements and discover a discrepancy in the records. The seller recorded a portion of future customer deposits as current year revenue. The seller uses this accounting method to inflate the historical earnings and threaten the agreed valuation. The negotiations then shift to working capital requirements. Buyers and sellers must negotiate the amount of cash, inventory, and outstanding invoices remaining in the corporate accounts on the closing date. An outgoing owner might drain those accounts and leave the new leadership unable to meet the first payroll cycle. You secure the necessary working capital through incremental negotiations with the seller's legal team. The closing attorney presents a document across the conference table. Your ownership stake exceeds 20% and triggers an unlimited personal guarantee requirement from the lending institution. The bank places a lien on your primary residence to secure the commercial debt. A corporate failure will result in the foreclosure of your home. You apply your signature to the page regardless of the personal risk. The retiring owner shakes your hand and displays visible relief rather than financial triumph. You now carry $3 million in debt at 32 years of age. The following morning requires you to enter a facility and inform a staff of veteran employees about your new leadership role. Many of these workers possess more tenure at the company than you have spent alive. Level 3, the operator. The staff ignores your presence on the first morning. Staff members ignore the signature on a commercial loan agreement when they work on a manufacturing floor. The general manager has directed daily operations for 19 years and treats your inquiries as personal burdens. The billing administrator understands the profit margins better than the new owner and corrects your assumptions. This operational phase ruins most first-time buyers through a slow accumulation of stress. You leveraged $3 million in debt to purchase an exhausting occupation. The company pays you a $200,000 annual salary. The bank deducts the monthly debt service from that entire paycheck before the funds ever reach your personal bank account. Commercial lenders track a single metric called debt service coverage. This ratio compares the available operating cash to the required monthly loan payment. The bank demands a coverage ratio of at least 1.25 to maintain a buffer against market fluctuations. A ratio dropping below 1 eliminates that buffer and forces the company to cover loan payments with non-existent funds. You implement a series of operational corrections to protect this ratio. You increase product prices that the previous owner kept low out of misplaced loyalty to clients. You terminate the client who has submitted payments 90 days past due since 2009. You invite the veteran general manager to a local diner for a meal away from the shop floor. You skip the standard corporate presentations and ask him to identify the operational flaws. He lists 4 specific problems, and you authorize the first 3 solutions using company funds. The general manager makes direct eye contact with you on the 4th consecutive morning. The company generates sufficient profit by the 3rd year to cover all debt obligations and corporate taxes. You take home an annual distribution approaching $800,000. The amortization schedule decreases the principal balance with every monthly payment cycle. The bank maintains the lien on your house, but the initial anxiety transforms into a standard line item on a financial spreadsheet. This financial success lures new entrepreneurs into a psychological trap. You achieve a comfortable lifestyle operating a single asset. An annual income of $800,000 satisfies the vast majority of first-time buyers. A less ambitious version of yourself would accept this outcome and cease expanding the portfolio. The initial acquisition process equipped you with specialized knowledge that a comfortable operator lacks. 10,000 business owners reach retirement age every single day. You possess the blueprint required to acquire their companies and scale your holdings. Armed with that blueprint, you step into level 4 as the acquirer at age 36. You hold full ownership of your first company and carry zero debt. You plan a move bankers would have rejected as reckless 4 years prior. You use your first company as the engine to purchase a second business, then a third. People miss the hidden mechanism driving these purchases. This process forms the foundation of a holding company. You acquire smaller firms one at a time, paying 3 to 3.5 times their earnings. Sellers in this bracket price their companies based on their own fatigue and personal spending habits. Grouping 2 or 3 acquisitions under a single corporate umbrella changes the valuation model. You consolidate their bookkeeping, merge their truck fleets, and combine their administrative staff. Buyers stop viewing the group as local shops and start valuing it as a mid-sized enterprise. You generate a 3 times return on a single dollar of profit inside a small firm and secure a 6 or 8 times return inside a larger enterprise. Your intelligence plays no part in this value jump. You purchase cheap earnings and place them inside a structure that doubles their market value. Professionals label this spread multiple arbitrage. Investors consider this practice the nearest equivalent to free capital in the economy. This transition shifts your focus from running operations to allocating capital. You hire a chief executive officer to manage your original company and appoint a controller to oversee accounting for the portfolio. You leave the shop floor to spend your hours sourcing the next acquisition. You fill your calendar with loan applications and meetings with retiring owners in their 60s evaluating your offer. This expansion requires you to layer debt upon debt. Every purchase forces you to sign another personal guarantee and accept another bank lien. Each added company must generate strong cash flow to prevent your portfolio from collapsing under the financial weight. Consider a roofing acquisition closing in March. The former owner suffers a fatal heart attack 6 weeks later, and his lead foreman resigns that exact week. You hold the deed to an operation stripped of its institutional knowledge. You watch your 4-year safety net evaporate over a single quarter. You stare at the ceiling at 3 in the morning, recalculating cash flow projections and praying for a better outcome. That 3 in the morning math produces results at level 5. You become the builder. Your roofing company stays afloat because you promote the dispatch manager who ran the place from day one and double her salary before she considers other offers. You turn 40 years old and wake up owning 8 separate businesses. This empire occupies a dedicated office floor with a proper brass nameplate on the door. You move past the scattered deal-making phase. You form a legitimate holding company. You shift your focus from buying individual firms to constructing an acquisition machine. A central management firm sits above those 8 operations. This parent entity manages the accounting and insurance. The same team handles hiring and financing. Those 8 companies used to botch those back-office tasks on their own with no oversight. They pay a monthly management fee to the parent company for professional support. That fee funnels cash from the local shops up to the top. The corporate structure and tax setup allow you to direct that money into your next acquisition. You execute the dividend recapitalization move. This technique stands as the cruelest and sharpest play in the entire model. A portfolio company finishes paying off its original acquisition loan. You bring in new lenders and load fresh debt onto that business. The borrowed money flows to you as a dividend payment. You hold full ownership. This move lets you extract your initial $90,000 investment many times over without selling the asset. The business absorbs the new debt burden. The cash lands in your bank account. You face the ultimate crossroads. Industry advisors push you to bundle those 8 companies and hire an investment banker. They want you to sell the whole portfolio to a private equity firm for a number with many zeros attached. The alternative route keeps the portfolio in your hands forever. You hold everything and let the returns compound year after year. Operators who built similar empires chose the 30-year path. They preferred annual distributions over a single exit check because a sale only pays once while businesses keep generating cash every single year. You spread both financial projections across your kitchen table on a quiet Sunday morning. The choice you make that afternoon shapes the next 2 decades of your life. You keep the decision private. You reach level 6 and build a holding company. Holding assets becomes your permanent strategy. You made this choice that Sunday morning and kept the decision to yourself. This choice drives every subsequent career move. You keep the first 8 businesses off the market. You refuse to sell the next 12 acquisitions. You celebrate your 47th birthday with your massive portfolio intact. That $500 million valuation represents actual cash value, contrasting with your 31-year-old fantasies. Your portfolio contains 20 distinct companies. You own air filter services and roofing contractors. You run commercial laundromats and pest control routes. You manage HVAC specialists and regional plumbing teams. None of these industries offer glamour. Every business generates steady cash flow. These combined operations produce hundreds of millions in annual revenue. Your personal equity stake across the corporate structure reaches $500 million on paper. One real-world operator using this identical blueprint manages 16 companies. That specific portfolio generates $350 million in revenue alongside $50 million in annual free cash flow. The owner maintains zero intentions to sell any individual asset. You see the entire business landscape from an elevated vantage point. Your comfortable 30-something self lacked the perspective to grasp this broader picture. Major private equity firms spotted this identical opportunity. Apollo Global Management owns a massive home services conglomerate. Blackstone purchased a similar platform for a reported multiple exceeding 18 times earnings. These massive institutions execute your identical strategy using billions in capital and abandoning personal savings account wire transfers. They pay premium multiples that you cannot match for the identical mundane businesses you acquired years ago for 3 times earnings. You share the water during your solitary 16-year fishing expedition with massive corporate vessels. You possess one structural advantage these giant funds lack. Institutional investors operate under rigid time limits. A typical private equity fund purchases a base platform, attaches smaller add-on acquisitions over 4 to 7 years, and forces a sale to deliver promised returns to their backers. You made zero promises to outside backers. You possess the freedom to hold these assets in perpetuity. You keep a 70-year-old founder's name on the office door because you have no intention to flip the building. A retiring seller in his 60s slides a financial folder across the table. You offer him the one guarantee no private equity buyer can provide. You promise to avoid gutting his life's work over 3 years to polish the financials for the next owner. You secure deals using that single promise that sheer capital cannot buy. You close the largest acquisition of your career this year. The seller sitting across the closing table happens to be your age. He stares at you with the expression you wore when you occupied the opposite side of the table. You recognize the wealthy buyer you used to fear at 32. You lack a clear answer regarding the ultimate purpose behind this massive wealth accumulation. A much older gentleman forces you to confront that specific question. Open that initial physical folder from 16 years ago. A man in his early 60s pushed the thick manila envelope across the wooden table and smiled with visible relief while ignoring the massive financial payout. You maintain regular contact with this specific individual over the years. He holds a unique spot in your mind as your inaugural acquisition. He picks up the check during a recent lunch and shares a secret he kept hidden during the final closing documents. 3 separate prospective buyers evaluated the company operations prior to your initial visit. 2 of those competitors possessed massive bankrolls and proposed premium purchase prices alongside faster closing timelines for the deal. The aging owner rejected both of those lucrative financial offers without hesitation. Those aggressive private equity firms used polite corporate phrasing to outline their exact operational plan. They intended to fire his loyal staff and liquidate the entire business within 5 short years. Retiring founders control $10 trillion in private company equity across the country. Market participants treat those massive assets as short-term inventory waiting for a rapid flip. The aging seller refused to become another rapid liquidation event for a fast payout. He demanded that his 31 years of hard work survive his physical departure from the commercial lease agreement. Your path to a $500 million valuation extracted a heavy toll from the other side of the negotiating table. The original owners absorbed that hidden structural expense every single time. Countless aging entrepreneurs shut their commercial doors each year because they lack viable exit options or interested buyers. Millions of retiring founders will list their operating companies during this current 10-year demographic window. 4 out of 5 of those active commercial listings will fail to attract a single viable financial offer. Those permanent commercial closures erase local employment, established delivery routes, and decades of personal sacrifice from the community. You secured the deal by making a specific operational commitment. Wealthy institutional investment firms refuse to offer that exact pledge to aging sellers. Acquisition professionals ignore this glaring operational dilemma. 10,000 retiring small business owners require capable long-term buyers to take over. Financial gatekeepers hand massive profits to investors who flip those acquired companies in record time for rapid returns. A dedicated founder must trust a complete stranger to protect a 30-year legacy after the original builder passes away. You honored your initial promise to that first seller. That original physical manila folder sits inside your primary office cabinet to this day. You sit at the helm of a massive $500 million enterprise and ponder your own professional trajectory. Modern financial gatekeepers might have blocked your ascent if you admitted to the public the rapid pace of capital multiplication when buyers break those exact promises to the original founders. The silent investors buying local small businesses began their careers through targeted buyouts. Family offices manage wealth across multiple distinct operational tiers. Accumulated wealth hits a hard saturation point. The funds shift into physical preservation vehicles like private art collections or agricultural land trusts.